Our next guest says that she expects the Fed to begin cutting rates in March. That's in direct contrast to Cleveland Fed President Loretta Mester, who will vote on interest rate decisions this year. Mester said yesterday that March is likely too early for a rate cut. Anne Walsh is the chief investment officer of Guggenheim Partners Asset Management. And first of all, thanks for being here this morning.
Thank you very much for having me.
So yesterday, the CPI came out. It was a little hotter than had been anticipated. And when you look through some of the lines, today we get PPI. And obviously, we're all trying to figure out what the Fed does next. Where do you think we are on track with this economy? What do you think the Fed will do?
So, as was introduced, we do believe that the economy is continuing to slow down. Inflation is also on a disinflationary track. Yes, the CPI print at a headline level came out pretty hot, particularly as regards owner equivalent rent. But if you look through to the component parts of the report, that really still indicates that PCE, core PCE, which is what the Fed really looks at, is still on track to be right around 2%. And I think that's critical. Additionally, what we're seeing evolve in the economy is kind of a bifurcated economy, and that is there's those companies that are doing pretty well, and then there's sections of the economy that are really slowing down significantly. For example, manufacturing has been in a bit of a slowdown, if you not maybe a recession, if even over the last, say, 18 to 22 months. And so as a result, what we're seeing is this sort of bifurcation happening, and the economy is continuing to slow down. We remain in the camp of believing that we are still seeing a recession, although mild. It's always been our expectation that it would be a mild recession. And, you know, I tend to refer to it as a rolling recession. Depending on where you are in the economy is how you're going to feel about the economy. And what's coming next is really commercial real estate, office properties in particular. And so we're still in this sort of evolution, if you will, of slowing parts of the economy down. We think this leads to the Fed being more in line with historical precedent in terms of recessionary environments, where they will be lowering rates, and a little sooner than market participants now believe.
What you're saying about the economy makes a lot of sense, where you're seeing the rolling recession work its way through. But what we're seeing coming down the pike could be concerning, too. Oil prices up 4.5% today after the U.S. and its allies made these strikes on the Houthi rebels on land. I mean, that's a big provocation. And it is a huge issue to see shipping costs start to climb up, too. You wonder if that's going to work. All of it's going to work its way through the supply chain. Increasing inflation, at which point I think the Fed would come down on the side of fighting inflation rather than saving the economy from a downturn.
Well, agreed, except they're already still keeping conditions relatively tight. Remember, they're still reducing the balance sheet. And quantitative tightening is occurring sort of in the background. A lot of people aren't necessarily paying attention to it because they're really thinking about rates. And by the way, the market does a really poor job of pricing in geopolitical risk and the expanding geopolitical risk. It's one of our macro themes for 2024 is the evolution of the hotspot around the globe. And so, yes, that is still a risk to the downside.
Well, Mohamed El-Erian was with us yesterday, and he pointed out that the Chicago Federal Reserve has this argument going that conditions are actually a lot looser now. Mm-hmm. Monetary conditions are looser, and you're seeing this activity. So even without that, the Fed may be having this internal argument about what to do.
Absolutely. And what we're seeing, though, is real rates are really still elevated. If inflation, particularly core PCE, is running around 2%, and you're looking at a 5.25 essentially, or 5.30 on Fed funds and so forth, then you're looking at a pretty tight real rate of interest for borrowers. And so that has a very significant slowing impact as well for the future.
What are you telling clients to do this year? You like fixed income, especially high quality fixed income?
High quality fixed income has performed very well in periods of time where the Fed goes on pause or starts their easing cycle. And so we think that's going to continue to be a very good place. We anticipate rates to continue to come down. The 10-year hanging around 4%. Our target is it will evolve down to about 3.5%. As, again, inflation continues to decline and the economy slows. And that's very well positioned for investment-grade fixed income. Corporate credit does well. Structured credit does well in this environment. So we really think that that's the best place to play the market.